Discover practical ways to find companies that not only pay dividends, but consistently grow them, helping you build reliable long-term passive income. If you're looking to invest for the future, dividend growth stocks can be a powerful tool, but not every dividend is created equal. Some companies cut their payouts when times get tough, while others keep delivering and even raising those payments year after year. So, how can you spot the difference? Today, I'll walk you through practical steps to identify dividend stocks with real potential for steady growth over the next decade. Before we start, remember, this is not financial advice. Always do your own research or consult a financial professional before making investment decisions. Let's begin by understanding why reliable dividend growth matters. Dividend growth investing is about more than just chasing high yields. It's about finding companies with a proven ability to increase their payouts regularly. This matters for two big reasons. First, rising dividends help your income keep up with inflation. Second, companies that grow dividends often have healthy businesses and disciplined management. But how do you find these companies? Let's break it down into a few simple steps. First, look for a track record of consistent dividend growth. The best place to start is a company's history. Has it steadily increased its dividend over several years, even during economic downturns? A good benchmark is at least 10 years of uninterrupted dividend growth. This shows the company can weather tough times and still reward shareholders. For example, consider Procter & Gamble. This consumer goods giant has raised its dividend every year for over 6 decades. Even during recessions, it continued to deliver increases. That's the kind of consistency you want to see. Another example is Johnson & Johnson, which has a similar track record. These companies operate in industries that people rely on, no matter what's happening in the economy. So when evaluating a stock, check its dividend history. Look for a pattern of steady increases, not just 1 or 2 years here and there. Next, understand the key metrics: dividend yield and payout ratio. Let's keep these two terms simple. Dividend yield is the annual dividend payment divided by the stock's price, shown as a percentage. For example, if a company pays $2 per share each year and its stock trades at $50, the yield is 4%. A higher yield might seem attractive, but it's not always better. Sometimes a very high yield signals that the market expects a dividend cut. Payout ratio is the percentage of a company's earnings used to pay dividends. If a company earns $5 per share and pays $2 in dividends, the payout ratio is 40%. A sustainable payout ratio is usually below 60% for most companies. If the ratio is too high, say above 80 or 90%, it could mean the company is stretching to pay dividends, leaving little room for growth or tough times. Let's look at an example. PepsiCo has a dividend yield of about 2.8% and a payout ratio around 65%. This leaves room to keep growing the dividend, as long as the business stays healthy. So when researching dividend stocks, aim for a yield that's reasonable, typically between 2 and 5%, and a payout ratio that suggests the dividend is sustainable. Now, let's talk about business quality and industry stability. A company's ability to grow dividends depends on the strength of its business. Stable, predictable industries are often the best hunting grounds. Think about sectors like consumer staples, utilities, and healthcare, areas where people keep spending no matter what. For example, McDonald's operates a global fast food business that tends to perform well even during downturns. Over the past decade, it has steadily increased its dividend. That's partly because people continue to eat out, even when money is tight. Another example is American Water Works, a utility company providing essential water services. Utility companies often have regulated, predictable revenue streams, supporting steady dividend growth. On the other hand, highly cyclical industries, like airlines or oil producers, may offer high yields, but their dividends can be less reliable during economic slumps. So, focus on companies with stable earnings, strong brands, and essential products or services. Next, review financial health and growth potential. A company's balance sheet tells you a lot about its ability to sustain and grow dividends. Look for manageable debt levels and consistent profit growth. Companies with too much debt may be forced to cut dividends if earnings decline. Let's use Microsoft as an example. While its dividend yield is modest, Microsoft has low debt and strong cash flow from its cloud and software businesses. This financial strength gives it plenty of room to grow its dividend over time. Also, consider future growth. Is the company reinvesting in its business to adapt to changes and stay competitive? Companies that balance paying dividends with reinvesting for growth are more likely to keep increasing payouts for many years. Now, let's discuss the importance of diversification. Diversification simply means not putting all your eggs in one basket. Even the strongest companies can face setbacks. By owning dividend stocks from different industries and regions, you protect your income stream if one company or sector runs into trouble. For example, you might own shares of a healthcare company like Johnson & Johnson, a utility like American Water Works, and a consumer brand like Procter & Gamble. This way, your dividend income doesn't depend on the fortunes of just one sector. Exchange-traded funds, or ETFs, can also help diversify. Some ETFs focus specifically on companies with long records of dividend growth. These funds hold dozens or even hundreds of stocks, spreading out your risk. Let's quickly recap the key terms we've discussed. Dividend yield is the percentage of a company's share price that you receive in dividends each year. A good range for reliable companies is usually between 2 and 5%. Payout ratio is the portion of earnings paid out as dividends. A sustainable ratio is generally under 60%, though it can vary by industry. Diversification means owning a mix of different stocks or funds to reduce risk and help ensure a steady income stream. Now, let's pull it all together. To identify dividend stocks with reliable 10-year growth potential, focus on companies with a long track record of increasing dividends, reasonable yields and payout ratios, strong and stable businesses, healthy financials, and a plan for future growth. And don't forget to diversify. Spread your investments across different sectors to protect your income. Remember, even the best dividend stocks carry risks. Past performance doesn't guarantee future results, and markets are unpredictable. The goal is to stack the odds in your favor by looking for quality and consistency. If you found this video helpful, please consider liking and subscribing to the channel for more straightforward investing guides. And if you have questions or want to share your favorite dividend stocks, let us know in the comments below. Thank you for watching.